Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with my good friend, Steven Pesavento. How are you doing today, Steven?
Kirk, I'm doing great. How are you doing?
Doing great. Doing great. Well, glad to have you back on the show. You know, you're a repeat guest. We don't invite everybody back, but we're inviting you back. So congratulations. You made the cut.
I feel honored. I'm so special.
Well, some of the listeners, I know we interviewed you, I think it was a year or two ago. So some of the listeners may not have heard it. So maybe you can tell listeners a little bit about your background.
Yeah, so I've been in the investment space for just over a decade. When I started my career, I started in management consulting and then worked in high growth startups and eventually made my way into the world of investing. And when I first got started, was focused heavily in the real estate market, heavily on single family homes, flipped over 200 houses in about 2.5 years. And today, our key focus is working with the right types of investors who are interested in collaborating, who are interested in co-investing into different investment opportunities, specifically in the real estate sector. However, we do work in a couple others as well. And today we buy large multifamily properties across the country. We do redevelopment deals right here in our backyard in Denver. And, we just love working with the right kind of clients.
Nice. So I know you also have a popular podcast, Investor Mindset, as well. And so kind of given your experience in investing, how do you kind of see what's going on now with real estate and investment opportunities? Like, where's your head at given kind of all the stuff that's happened in the last year or so in the market?
Yeah, so this is such a great question because we talk about this on the Investor Mindset show all the time, because over the last 2 years, 3 years, 4 years, we've seen, the market be able to change direction within a very quick, short amount of time. So part of the principle of living with the investor mindset is understanding this idea of what is the purpose behind the investments that you have and whether they're short-term or long-term focus. So a lot of our investments are long-term focused so we can weather the storm that might be happening in the short run. So right now, what we're seeing in the market is in the last 12 to 18 months, we've seen a very different picture than we did previously. Meaning we were in a very competitive market, buying, typically we're buying 200 to 300 unit apartment buildings in prime markets like Dallas, like Denver, like Phoenix, like Central Florida. And it was extremely competitive. It was hard to get great deals, but, we're still able to find them. Oftentimes we'd look at, 100 deals before we'd actually find one that penciled. What we noticed was in the last maybe 6 to 12 months, there's been a radical change in pricing. The biggest change is that as the Fed has raised interest rates, buyers, and we're a buyer, buyers in the market are not in alignment at all with what sellers are asking or sellers are expecting. So, in comparison, in 2021, we bought, 8 multifamily properties, probably 12 or 1,400 units in total. And in 2022, after the Fed raised interest rates, we closed on 2 properties, 3 in total, 2 after the Fed started raising interest rates. And the biggest reason that is the case is, frankly, sellers are still having a high expectation that they're going to get absolutely the most money for their property. They're still thinking that they have the capability of getting 2020's prices versus where we're at in 2022. So it's been an extremely difficult market to find really great deals. And because we've been investing for a very long time, we have a nimble, small boutique team. We don't need to do deals in order to keep the operation running. And so we're very selective about those opportunities we do. And so what we're finding is that the only types of deals that make sense, they have some type of distress connected to that seller, connected to that person who owns the property. And they have the motivation not only to reduce their price, but also to be able to provide some type of favorable financing options, whether that's assuming an existing mortgage that has kind of a low interest rate attached to it, or getting seller financing. And so it's a tough market out there when you're a buyer shopping, but patience is the key.
So I love what you're saying that, we're talking about, you're willing to be selective. I think one of the challenges that investors have is they're too eager to invest. And I saw this in 2021, I saw it in 22, where people are scrambling to buy real estate before, I don't know, before what, but they feel like they need to do it. So how do you kind of get around that with investors? Investors are just, some of them are just making, I don't want to say stupid decisions, but it's like investing in tech stocks in December of 99 and assuming it's going to keep going up forever. How do you kind of get people by that? Because that's hard. That's the whole fear and greed aspect of investing.
Yeah. So this is where education, consistently communicating our beliefs, and really attracting a set of investors who share those same beliefs is really key. On the Investor Mindset Show, we're often talking about, hey, well, this is what we believe. This is what we're looking for. This is how we look at the game of investing. And it's really a game, right? And if you want to win the game of investing, you need to know how to play the game. You need to know the strategies, and you need to know the rules. And so one of the biggest mistakes I'm seeing a lot of investors make is that they're purely looking at what is the return that's being projected on paper, rather than having any kind of understanding of the project itself or the team underlying that is actually going to execute that business plan and strategy. So here's a great example. I'm talking to an investor. This is a couple months ago. I'm talking to an investor. Let's call him Paul. And so I'm talking to Paul, and Paul has invested in multiple projects with us, and he is primarily focused on cash flow. He's primarily focused on creating income, and that's really all he's thinking about, right? He works, makes a ton of money in his job, and he's just trying to create another income stream. I love the philosophy. However, one of the things that I noticed was that, we would put out an opportunity and he would say, hey, you know what? I like the deal. I like a lot of things about it, but I'm really looking for like 8-10% cash flow, maybe 12%. And I'm saying to myself, hey, I know the market. I haven't seen a single deal like that. When I underwrite it conservatively and I take into account what's the worst case scenario of what can happen. And so as I'm talking to this person, I start asking questions. I start understanding where he's coming from. And then he alludes to, I finally get him to share some of the past investments that he's made and what he's looking at. And he tells me that he recently invested in a hotel conversion in a small market, essentially converting a hotel from one brand to another in a very small market that was going to project like 10 or 12% cash. Hotels are extremely up and down, right? The hospitality can be a great place to make money when it's good, but there's a lot of downside when it's not. And so he lists that. He lists another project that's more of a development deal. And that led me to ask him, just to clarify. I said, okay, great. I didn't recognize that you were so comfortable with risk. My understanding was that you were looking for, the safest bet that gets you a really good return. And this is where I think a lot of investors make a mistake, because they're not clear on what they actually want. They're clear on what they're looking for on paper from an investment, but what's the actual outcome at the end of the day that they're looking for, knowing what that target is, and then also understanding the fundamentals of what goes into that investment, because he actually didn't know that those investments were higher risk. He thought it was exactly the same as doing something that's a low leverage multifamily deal, or the same as getting into preferred equity, or the same as investing in something that's more of a fixed income promissory note or debt option. He did not realize or understand those differences. And so that is one of the biggest mistakes, is that if you're going gung-ho and you're not clear on your target and you don't understand the fundamentals, you can get into some positions where you can get hurt. And, as a manager, that's what I want to help my clients avoid. But that's definitely one of the biggest things that I think people need to be aware of.
Yeah, no, I love that. I think one of the challenges that we see a lot is people don't understand the risk they're taking. It's so common. So I love that you're kind of saying this, because I think one of the things that happens a lot is people see the expected returns. They're like, oh, the expected returns are 20%. That's what I'm going to get. Like, that's not necessarily what you're going to get. But like, maybe if everything's perfect, you'll get that. But I think I think you're kind of really hitting the nail on the head with one of those challenges. Is usually when we talk to people, like, oh, I've got these 5 real estate deals, you got some mobile home park, you got these other things, and they all sound good on paper until you look at them, you're like, wow, this is a mess.
Well, and this is where it's a little bit more complicated than just looking at an offer memorandum, is that you really do have to understand like the values and the way that the operator who is going to execute that project is actually underwriting the deal, how they're actually planning to go about executing that business plan. And the hardest part about this is you might hear the word, oh, it's conservatively underwritten, but what does that really mean? It's really about understanding the fundamentals of that deal itself and knowing, okay, well, they're projecting that it's going to be a 15% return. And I see this one's projecting 15 and this one's projecting 20. If we just looked at the numbers, I would obviously want to go with the 20. But if, as I dig a little bit deeper in and I understand the thought process, the mindset of that operator, I find out that they have 15 written here on the paper, but that there's actually a lot of income opportunities that aren't outlined, or there's a lot of additional reserves that were added to the project, or the debt is long-term debt with fixed rate financing, and you've been able to remove a number of those different risk factors so that you can last out and be able to be invested in that project for the long term. So I think that's one of the things that people really do have to understand, is that it's not as simple as just comparing one piece of paper to another. There's some fundamentals that, you really have to learn in order to understand, hey, is this really going to be what I'm looking for, in the next 3 to 5 years from the outcome of this investment?
Yeah, no, I agree. I think that's really important. So how would you go about educating somebody? Because obviously it's a real problem and most people just look at the performance, they never look at the risk. How would you go about educating somebody on how to look at things properly?
Yeah. So when it comes down to understanding a deal in the alternative investment space, whether we're talking about a multifamily real estate deal, whether we're talking about industrial, whether I'm looking at the energy sector and we're looking at investing in, cash flowing oil and gas, or I'm looking at, anything along the way, you have to understand the market and the asset class that you're investing in to understand what the different risks are within each of those different buckets. So there is some baseline knowledge. You have to get up to speed to understand that specific asset class. So it's going to take you a little bit of effort to be able to wrap your head around that. And then the second piece is, it really, in my opinion, when investing in private investments, I'd say 90% of it comes down to who's the operator, who's the sponsor that is responsible for executing that business plan. Because when it comes to private equity, if you're a limited partner, you're investing your $500,000 check into this deal. The beautiful thing is that once you make that investment, you are passive, right? Now, there is things that you have to do, some taxes and some other, but once you've made that initial decision to invest, that's it. Your responsibilities are over, as well as your control of making those decisions. So all the work you're doing up front is really on this due diligence process. It's about sitting down and researching that sponsor. It's about having multiple phone calls or opportunities to be able to engage with the team, to be able to ask those key questions, right? A lot of the questions can be answered by looking at the offer memorandum, but then coming back to that sponsor and being able to ask key questions like, how did you go about underwriting this? What is the growth rate that you're expecting? What is that compared to, the market? How much additional room? What's the sensitivity analysis here? At what point does this deal break even? And there's some specific questions that you're going to ask, and there's not a perfect answer, but based on the answers that you hear are going to lead you to have a better understanding about how they're looking at the opportunity. And then, of course, whenever investing with somebody in a private placement type situation, I always recommend, you got to try before you really invest deeply. You've got to have an opportunity to invest a little bit of your money with that operator to see how they actually, how they work. And I think one of the best ways to find those people is through referrals of folks who've worked with them for a long time, or advisors and people who really do understand the business. Because if you're really, if you're a limited partner and you're a passive investor and you don't do this all day, every day, it can be difficult for you to know all of the things to ask. And so oftentimes that's why having the right team of advisors around you who can review opportunities and provide you that oversight to make sure that you're not stepping in the wrong pothole that could really take the car down, is exactly what you need to do.
Okay.
And what I'm curious from you, Kirk, is when you're talking with your clients, how do you go about recommending that they understand the different risk within different types of investments across, different asset classes?
Yeah, I mean, that's a good question. I think, there's what we do on the show here, and then there's what we do with our clients. And a lot of what we do with our clients is we do that for them. So we analyze all this for them and explain, like, here's the opportunity, here's the risk, here's the upside. I think this fits within the realm of your kind of tolerance for risk based on my understanding of the client. And we have a conversation about it, but, typically we do that for them, because I think that we definitely get clients who come in who know the risk and reward dynamics of an investment. And sometimes they want to do that inside of a retirement account. So they just want us to help facilitate that. But, we always we have I don't want to say unique, but a kind of a rare perspective in that we're really focused on risk tolerance. And then we understand risk at a very deep level that most people don't. And, I'm not, special in that way, although I think I'm kind of wired for it. But I think it's just a lot of experience, seeing a lot of things that worked and didn't work, and, just learning from other people. There's tons of people. I mean, you can look at like Bernie Madoff, right? Like, we never got caught up in that, but I learned a ton from that, right? I met Harry Markopolos. He's got kind of a big ego about the whole thing, but he's a very smart guy. And, I've followed what he did, and you learn a ton just from that, right? Or, at some point we'll learn a lot from SBF or whatever the guy's name is. We learn a lot from that. And you hear all these frauds and you learn from them, because, at the end of the day, most of the problems that we worry about are fraud, or, it's not bad operators, because you just can't predict that at some level. Like, you can do your best, but sometimes things just don't go your way. And there's just an element to that in every investment. But what we worry about is like the frauds, because there's a ton of them out there. And, I know there's some people who have like their black book of bad people that they just don't work with. But unfortunately, because of the self-directed part, we see this a lot. People come in, they say, oh yeah, this person told me this is a good idea. And I look at it, I'm like, I would not go anywhere near this if I were you. Advise them to kind of go in a different direction. I mean, we've seen this like a handful of times where we've actually turned in suspected frauds into the SEC. And, I don't know what happens to it after that, but we just like, yeah, this is clearly a fraud. You guys should look into this. So,
and that's the biggest challenge that I think most investors have, is that what you just explained is what I was explaining as well, is like, based on both of our experience, when I look at a deal, I can immediately start to identify what are those different things that are going to trigger me to say, I don't know if I trust this. This seems like too strong of a return, or the growth projections are too high, or the loan to value is too high compared to the reserves that they're keeping. There is some rules that you can follow, but it's difficult because every single investment in each market has its own set of rules. And that's actually part of the game that makes it possible to create a much higher return in comparison with the risk you take. when it comes to alternative investments and private placement deals is that there is insider information. You have the opportunity to be an insider, where in the traditional markets, you don't. If you have inside information related to, Apple, and you trade on that, you're going to go to jail. But when you have insider information related to a multifamily deal or an oil and gas deal or promissory notes or what's happened, these are the things that, because you have either an insider relationship or you have that knowledge yourself, you're able to position the type of returns that you get into a much better bucket. And so that's usually what I recommend people to do is, it really comes down to getting into a really great community of people, like-minded people who are like you, who are investing in these different spaces, and where you can change the way that you think about money, that you think about investing, and you can actually start living and taking on that investor mindset over the traditional mindset. And then the second piece of it is really does come down to building your team of advisors. You want to work with great CPAs, attorneys, financial advisors, risk professionals, operators, people who you can lean on and say, hey, I'm looking at this deal and I know it's not related to a project that you're running, but would you consult with me on this? And when you find the right people and you're willing to, pay them in order to protect you, that can put you in a position where you're able to make better decisions because you have better information.
Yeah, no, I completely agree. There's one thing that we were kind of on the edge on, which is, looking at deals like this and seeing something and saying, that doesn't make sense, right? Or just something that sticks out and it's like, if I get this a lot, right? Like every fixed income, or let's just say private mortgage, right? Private mortgage are getting like, I don't know, 10 or 12% for a handful of years. And I have one that comes to me, it's like, oh, it's paying 25%. Like, I don't know. It doesn't make sense. Like, and I think it's the active questioning that's important, right? Like, I know you do this, but like just asking the right questions, right? Like, okay, why is this different? Because so for example, and I want to go down this path because I know you do promissory notes, but we do private mortgages and we get this question all the time with new clients. Like, hey, this thing's paying 10 to 12% a year. Why? Everything else is paying 0. Why is this getting 10 to 12, right? And well, the answer is because it is. Like, it's a different kind of investment, and here's the reason, and we kind of go through it all. I'll let you talk about it because you're the guest, but like looking at stuff like that, when people say, well, why would I be able to get that much when, I'm getting 0 in the bank? So like, how do you address that?
Yeah, well, part of it's because it's an inefficient market, right? It's an inefficient market, meaning, if you go to the bank and you get a traditional mortgage, they're going to, give you a mortgage at, 5%, 6% today. Who knows where it's going to be at tomorrow by the time this comes out. That market is extremely efficient. There's a lot of players in it. There's a lot of people competing in it. In the private note space, in the bond space, oftentimes you're taking a little bit more risk, but you're typically attaching that risk to an underlying asset or an underlying balance sheet. And so the business itself is able to look at and say, hey, well, if I raise money at 7% and I pay a 7% coupon and I pay that every single month, but I know that person's committed to investing in that deal for 3 years, then they're able to make the calculation to say, hey, well, if I borrow that at 7% and I know I can make 10, then the company is going to make a 3% spread. And that 3% spread out over tens of millions of dollars per year can really go to funding an operation for that company to be able to grow. And so, in our world, these promissory notes are typically attached either directly to real estate or to a company's balance sheet that is going to then go acquire that real estate. And so when we put together an offering and we have $10 million in the bank, and we know that it's going to require, $8 million to purchase this property, and we can do so in a very fast manner. We can do so without having a bank involved. We can do so without having to draw out the process. We then put ourselves in a position to be able to move extremely fast. And when it comes to being able to buying great deals and creating really strong returns, like I'm a value investor from day one. Started out flipping houses. Everything I've ever done has been about finding a problem and profiting on solving that problem, right? I don't buy anything that's at market rate because you don't make money at market rate. Maybe you do if the market's going up, but we don't ever want to bet on that. We want to bet on, we know where it's at today and we know where it's going to be at when we're finished. And we want to be able to create, a good chunk of profit within there. So by taking on this debt at, like you were talking about, notes at, 7, 8, 10, 12%, we know that by us taking on that note, we close on that deal, we're able to do it more quickly. We might save $1 million or $2 million, but we're paying out a few $100,000 to investors in order to create that value. And then we'll go back and refinance that with our equity investors who participate in the upside on that project. And we're able to then create value for them. And so it's all about this flywheel. And that's why when you're investing in notes or bonds, it's extremely important to understand, well, what is the strategy? Where is that money going to go? What is it connected to or secured against? And what is the track record of being able to execute with that strategy?
Yeah, no, I appreciate that. That's really important. So so one question that comes up a lot, and I get this about real estate investors, is everyone's looking for passive investments. And, I look at real estate and say, there's nothing passive about real estate, unless of course someone else is managing it, right? So how do you kind of get over that mental hurdle when you're talking to people when, there are a lot of, we call them investing half-truths, where people think something's true, but it's really not 100% true, right? Like it's not really passive. It can be, but people have this illusion that everything will just be easy. I just buy it and it'll take care of itself.
I think this is one of the big myths when it comes to investing in real estate, is that a lot of people believe that if they go buy a piece of real estate and they're the decision maker, they're the one putting all the cash down and they're the one finding the deal and funding the deal and managing the deal. They think that they're going to be creating passive income, but they're not. They're creating active income that might come in from a tax perspective as passive, but you've got to invest your time, effort, energy to go out and find the deal, fund the deal, and manage the deal. So real estate is 100% an active investment. Even if you go and put a property management in place, you might then move from active to semi-passive, but you're the asset manager. You're the one who has to make those decisions every single day. The way that real estate becomes passive, though, is you invest in real estate the same way you'd invest into a hedge fund, the same way you'd invest into private equity in a business. When you're private equity in a business, oftentimes you're not the manager or the operator of that business. You're the check writer, and you receive a return on the money that you invest. So in order to be a passive investor in real estate and get truly passive income, you've got to invest that capital with a great sponsor operator. And that's the person who's going to go on your behalf, go out and buy, operate, manage. And then typically those individuals, those companies, they receive fees for doing the work and they receive promoted interest, meaning they receive a percentage of the profit that after you've received a certain rate of return. So the way that you get passive is you have to invest into companies that are actually the ones who are going out and doing this on your behalf. And that's why it's so important for you to understand who are those operators, who are those companies that are going to be making all those decisions, because that's where success or failure comes. And, when you align yourself with the right expert and they're working on your behalf and they profit after you profit, that's the best kind of arrangement that you can really find in the investment world.
So one thing, I know in the interest of time, we have to kind of wrap up soon, but what, lots happened in the last few years in the market. Where are you seeing the best opportunities? And, what areas are really kind of the bad apples from what you're seeing out there?
Yeah. So what I would recommend for people to focus on is that in this time, we're talking beginning of 2023, the Fed just started to slow down on raising interest rates. So we haven't really seen a ton of change at the real estate level yet, right? It takes time for that world to shift. It's a slow moving barge versus a speedboat. What we're seeing in the market is that it's extremely important to be patient and to really understand what is that underlying asset and what is the value that's being purchased at the beginning. Like, how big of a discount or how great of financing are you getting? So what we're targeting, what we're looking for right now is we're looking for deals that we know we have the ability to raise rents by 30 to 40% based on not any kind of rent growth happening in the market, just purely based on that property being undermanaged, where all the comparables are 30 to 40% higher, but this one is not being managed well. So that's where that opportunity is. Oftentimes for us, that comes with construction, that comes with coming in and renovating and updating and improving that property. These kind of properties are extremely rare to find. When we find a property that fits the types of returns we're looking for, it happens only every so often, because right now that's the biggest challenge in the market, is finding sellers who have a distress or motivation. So if you're an investor, I'd recommend taking a look at understanding, how is this thing being financed? I would prefer to be in something with fixed financing, longer term financing, longer than 3 years, preferably 5, and where there's some great upside, and that upside's coming from renovating and fixing up the property or improving operations, and there's really strong comparables. Now, if you're not an expert in the space and you look at a deal, it's going to be harder for you to know those details, and that's why you're going to want to align yourself with great advisors who can help support you in that. Things to look out for is anything that's overly projecting, anything that's projecting returns that seem unreasonably high. Like, if you're looking at a lot of deals and everything, a projection on a piece of paper is just that. It's just a projection. You really have to understand the underlying mindset and how things, are actually underwritten. So in summary, I'm bullish on where the market can be in the next 12 to 24 months. I'm very patient on looking for good opportunities. I think there is very few of them out there, but when you're aligned with the right people who have access, that's how you get into those. And I'm very bullish on getting into, notes that have great returns and where you can park your money for 6 or 12 months or 24 months and still be able to create a return, because inflation is real. And although you want to have cash ready to go to put into something, you also want to make sure that you're not just burning a hole in your bank account by just endlessly sitting on cash. So that's my view on it. And that's what I'm looking at in the market.
Okay, cool. I like that. I know there's be a ton more opportunities in the next few years, I'm sure, given all the volatility going on. So Steven, as we kind of wrap it up here, what are some final thoughts you want to leave our listeners with? And then where can people find more about you?
Yeah, the biggest thing that I want to leave you guys with is this realization that it's extremely important to get clear on what you want and why you want it. Why are you investing? What's the purpose behind the investments that you're making? And where is it taking you, right? Investment is just a vehicle to get you to your end goal and destination. Real estate's a great vehicle. There's lots of great vehicles, but you want to choose the one that actually fits where you personally want to go. So we talk a lot about this on the Investor Mindset Show. If you've liked what we've talked about here, we've got some great things coming out, including a new show called the Name Your Number Show, where we really dive into how do you set this target, how do you get clear on your vision, and then how do you actually put together a plan to be able to vet and understand what deals fit what you're looking for versus those that you should absolutely run away from. So if you're interested, definitely go subscribe to the Investor Mindset Show. And we've got a great free resource for those who are interested in understanding more about passive investing in real estate. You can grab that at vonfinch.com/playbook. It's a 56-page document that, really summarizes what you need to look for and how to avoid some of the biggest pitfalls that people make when it comes to, investing passively in real estate.
Great. Well, Steven, I really appreciate you coming on the show once again. And, I'm sure we'll have you back on in the future.
Awesome. Thanks so much. And look forward to connecting with you all.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Steven. Really appreciate him coming to the show again. Always like having him. And now we're into the panel portion of the show. We have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing today?
Doing great. Doing great. And we also have our very own Doug Heagren. Hey, Doug.
Good morning, Kirk. Heagren. How are you doing today? Look, eventually we'll get you on that page. But no,
eventually I'll get it, Doug.
Glad to be here. After 52 weeks of doing these together, we'll have it nailed. No, that's always great to be back. I appreciate being on every time. Thanks.
And I appreciate you pointing out my inadequacies, Doug. Thank you. We'll be here all day if we start doing that. So anyway, back into the panel portion. So Megan, what were some of your takeaways from the interview?
Yeah. I think the thing is, one of the things that I want to talk about today, and I know Doug does as well, is this idea of due diligence, right? We talk about this a lot on the show. I think due diligence is one of the hardest aspects of investing. I think it's also why people like passive investing, right? Because it's far easier to do a basket of ETFs that are robo-managed versus doing due diligence. But diligence is really time consuming, and it covers a lot of different areas, not just the financials and the performance, but even looking at things such as security of the firm, looking at the principles, looking at, just what are the issues within the industry that you might be investing in. So due diligence is a very, very time consuming process. But I do think that what I would tell anyone who wants to start looking for their own investments is you can do your own due diligence. You just really should come up with a checklist of all the areas that you are focused on. So that's sort of my first sort of look at this today.
Okay, great. Thanks. So Doug, what are some of your thoughts?
Well, I touched a couple of things. I mean, especially, due diligence is a big one. I mean, where do you turn for trust? He talked about some different ways to do that, but there's plenty of stories of people that have done due diligence. We talked about this before on the panel. They've done due diligence and found that when they thought they had all the answers, they didn't, or what they were trying to do due diligence on was very, very good. at concealing information, that information in a way in which not only, their due diligence not turn out to be what the level it needed to be, but also all of the people that they were using for that due diligence. Passive versus aggressive, passive versus active investing. I mean, people have to take time. This is an interesting situation that we're faced with. Is nobody has time anymore. We're busier than we've ever been, but yet I find it to be contradictory that as busy as we are, we're also in a state of mind where people are trying to take more control back. And maybe they feel more out of control than they've ever been. So you get this, I'm going to do it myself mentality at a time in which between school, work, social media, you name it, time has been squeezed in ways it has never been squeezed before in the history of man. But yet we're trying to do more of that stuff ourselves. You can't do both. And so ironically, at a time where we probably need to think about outsourcing, think about being able to defer responsibilities, get that support, get that counseling, we are also trying to grasp for as much control as we can and take over things and do it ourselves, which makes it that much harder to do the due diligence and research you have in the limited time, even though there is more information out there, which can also create information overload. So where do you turn? So I think, again, that active versus passive is a really, really interesting topic. He also talked about real estate, what's going on there, and just kind of the entrenchment that I think we're starting to see coming out of COVID in terms of, buyers, sellers, who's got the upper hand right now.
So, yeah, I wanted to pull on that thread real quick, and I'll let you get to it, Megan. You're talking about the active versus passive, which I think is really important, is that this thread actually wraps into most of what we're going to talk about today. What you said, Doug, is that there are so many people that are doing too much, right? We're all overwhelmed. We all have way too much to do in too little time. And technology has not made our lives easier. It's made our lives more stressful. It was supposed to make it easier. Oh, well, look at all this extra time we'll have. Well, all that extra time went back into work and just made it more efficient. So I think the challenge that I see, and coincidentally enough, I had a conversation with a prospective client yesterday about this, where he was like, yeah, I'm competent enough to do it myself. Like I've done it myself. I have a big background, but I just need another set of eyes. And, I look at this, I'm like, that's a really smart way to look at it, right? Is that you don't have the time to do it yourself, right? Like, Doug, you and I, Megan, we all kind of have our own portfolios. But I probably put less time into my own portfolio than everybody else's because I just don't have the time to do that. Like there's a certain limitation of time that kind of comes into things. And this is one of the struggles, right? When it comes to due diligence, right? And this is going to wrap this back into due diligence, is people don't have time to do proper due diligence. The amount of time you have to put in, think about like Warren Buffett. Now he's probably on the extreme slow side, but here's a guy who takes years of reading annual reports before he moves on a company. And, maybe that's the better approach. But, trying to do due diligence on a company these days, well, it's easier to get the information. Everyone else has that same information. So if you wanted to really not be subject to like a Bernie Madoff, then, you have to do an extreme amount of due diligence. The problem is no one else is doing it. So if you were to outsource it to other people, they're probably not doing it. And that's how Bernie Madoff got so far, is because no one was really doing their due diligence. You got Harry Markopolos and maybe a handful of others that saw it. They were it. Everyone else was like, oh yeah, he's a big name. Everyone knows him. He's fine. So they didn't bother to do it. And then you end up with the biggest Ponzi scheme of our time. And I think that's one of the challenges of people trying to outsource what they do, is how do you outsource it properly when the people you're outsourcing it to are not doing their job? So that's an open question I have. But Megan, what did you want to say?
Oh, it was interesting. I recently had an issue with due diligence that I think brings up one of the risks out there. And, I work with a number of endowments. And when you're on endowment boards, you are usually, for due diligence, you hire a provider who manages your due diligence risk. And in this situation, without getting too into the weeds and the details, we had recently invested in a manager that met due diligence requirements on an institutional level. It was going to give us a very unique access to an opportunity set that in this type of market tends to do well and provide us with a significant income stream. And unfortunately for us, the risk that got us on this that we're working through today is unfortunately the senior most manager of the fund contracted an illness and died very, very quickly. And so that brings up something called key man risk that I often think we don't think through enough when we're getting investment opportunities outside of the institutional space. In the situation I'm dealing with, they have mitigated the key man risk because they had a succession plan in place. But I think this is important for our listeners because, you know, when people come to you with ideas to invest in, right? Like, come do this, like we can make this, we can make that. Some of the questions that should be on your due diligence list is, okay, who drives the strategy here? Who is the key man, right? Is all of the relationships or all of the decision-making in that one person's hand, or is it spread amongst a team? And in the event that person is hit by the proverbial bus, what is the succession plan you have in place for them to step in and mitigate risk? And so I bring this up because it's one of those risks that, you know, you don't expect some manager in their 40s, 50s, or 60s to pass away suddenly, but it does happen. And so you want to make sure it's not just one guy or one gal who's running strategy. And so I think that that's really important with due diligence. And I feel fortunate in the situation I'm working with. We knew in asking the questions going in what the succession plan was. It still doesn't mean we're not going to go back and do another round of due diligence, but we also know that because the succession plan was there, we are protected. So that's one of the things I thought was just sort of the conversation sort of triggered in my mind about what I've just recently experienced.
Hey, I want to add on to that, Megan, because actually you brought up a really good point. So in fiduciary oversight of 401k plans, one of the checkpoints that we look at when we're looking at what kind of how to screen the funds for being maintained in the plan. Although it's not probably the biggest weighting is obviously cost and, you know, benchmarks and performance risk, but it is manager tenure, right? Because when you have all of a sudden this significant jarring change that comes through, and a lot of times, I hate to say it, I don't know if it's as much the case in this day and age as it used to be, but a lot of investments were really celebrity driven, right? I mean, you look at the days of Peter Lynch, right? The master of this fund. And, you know, I'm forgetting some of the other great contrarian investing names. They're running this fund and they would move them from one fund to the other to say this manager's taking over this fund and everybody would want that fund. And then the fund wouldn't necessarily perform like the old fund. So who knows what the real reason was, but they became celebrity driven. A great example back in the day was the IDS New Dimensions Growth Fund. It was a fund, you know, it's long ago, I can probably talk about it, but IDS New Dimensions Growth Fund, everybody in IDS got put into this fund. It was a rock star, multiple returns. Well, then they had, I think, a death of whoever's running it or something occurred. They didn't really communicate that out to the public, but they kept pushing this fund. This fund went from significant alpha for years to eventually performing so poorly that it got merged into another fund and people lost tons of money on this thing. Okay. But it continued to be sold based on the name and reputation of the past that no longer applied to the present circumstances. So it is critical to stay on top of those changes and understand what's really going on, because just because who's behind the scenes can change so significantly in such a fast period of time, and that name alone, living off the past, may not necessarily create a situation that's going to be great for you in the future.
It's totally right. And it's the whole past performance is not indicative of future performance. But yeah, I mean, it's that idea that if you're going to go active management, you're paying for the secret sauce, right? But more than one chef needs to know the secret sauce. And it's hard. It's really hard. And these are questions that, you know, people sometimes I think brush by quickly, but they make a difference. They really, truly do.
So what you're saying is don't have your investment done with the Coca-Cola recipe so that nobody knows it.
Exactly. So
It's interesting, the key man risk, because I think it comes to two parts. And one is certainly key man risk. If you're investing in a mutual fund, you might say, well, what if the person dies? Let's say, well, if the person dies, then I go take my money and reinvest somewhere else, right? It's if you're in an illiquid investment, something you can't move, like a private company. Like I'm sure, Megan, you invest in a lot of, private equity and private companies, and that is a problem because you can't get your money out. You can't just move it. And I think that's, so it's really important, especially in the alternative side, to do your due diligence. And so few people are good at it.
well, and by the way, Kirk, you bring up a really important point, because 2 days ago, I had a client reach out. They live in a foreign country, but it's an opportunity that I think a lot of people get, where somebody in construction, like a developer, was saying, hey, if you loan me X number of dollars, you'll get a return of 12%, right? And he was like, it sounds really good. And one of the things I immediately brought up was, first of all, what happens if something goes wrong with the developer, right? Where are you on this? Do you even have legal protections in a foreign country? And it came down to this idea of, in a diversified private credit fund, you can get 9, 10, 11%, and your risk is diversified. Why are you going to tie it up with this one key person and one key project? And I think the value that like you bring and Doug brings in working with clients is you can challenge them on this thinking, right? You're the guys who say, right, in our roles, we say to them, does this really seem like a good idea, or would you be better served in this direction?
Yeah, no, totally agree. So let's get back into the active versus passive conversation, because I think that's really important. There's always this misunderstanding when it comes to active versus passive. I know, Doug, you see this a lot. So kind of what are your thoughts on this, Doug, as you talk to a lot of people who are just like, I just want to put my money in passive investing and forget about it. Like, what do you say?
Well, what I see is it's complex. Passive has quite a few definitions to me. So what is a passive investment? We can go back to the Bogle definition of passive investing, which is buying an index fund, right? And the key is to get the cost down as simple as possible, that you can't beat the index. That's fine, but that's just one layer, because maybe that investment is passive, but how are you going to elect your allocation? Because you've got to have more than one investment. So now, are you just going to go passive on your allocation? I'm just going to buy, like the perfect portfolio, they used to call it, the permanent portfolio, where I'm just going to buy, treasuries and real estate and international and, large cap US. And I'm just going to have those 4 things, 25 each, and I'm just going to keep it passive. Okay, well, it's passive. It's going to move. Are you going to rebalance? It's no longer passive. Right? So how are you going to have the oversight to determine when you want to make those adjustments? And how are you going to have a methodology? This comes down to a methodology. There's no such thing as a perfect process or a perfect methodology. It's just, does that methodology or that process make sense and work for you? And then stick to it. Too many people flip-flop their methodology and their process. Reminds me of a client several years ago. It's an older lady, and she had a lot of money in cash and annuities. Okay. And she wanted help because she's trying to get more, trying to get some idea on how to allocate. She wanted this help, got the help. Of course, like so many people, she wasn't making enough money. And I tried to say, look, you're probably not going to want to take the level of risk that's necessary. I know time's been good, wasn't making enough. Well, guess what? As soon as times got a little more volatile, then she was losing too much. It's the typical story. So what's the methodology in the process? You got to stick to it. And so, even at the passive level that I was talking about with Bogle, okay, even companies like Vanguard have written white papers saying, I know marketing, branding is all about inexpensive, low-cost ETF or low-cost mutual funds, no cost. But guess what? They have written white papers that say, well, passive doesn't work in all these areas. We're primarily referring to like large cap US companies. Well, there's only 500 of them in the S&P 500, and only a handful that actually make a move. So it is hard for an active investor these days to beat the S&P 500. But that's not the case for small cap. There's 2,000 listed in the Russell 2000. It's not the case for bonds, which are so much more risk sensitive or rate sensitive. It's not the case for emerging markets where there's tens of thousands of companies to choose from. So even at that level, even some of these that have marketed passive have said active actually does work here. But I think there's such a drive to get my cost down. The cost is everything about the returns. Kirk, you and I were looking at, so I put together a report of returns of the S&P 500 over the last 75 years and the last 25 years. Do you want to take a guess what the, and you've cheated on this, Kirk, if you've looked at it, but do you know what the rate of return in the S&P 500, Megan? I'll ask you. And the last 75 years was approximately.
I want to say it's like 8% or something, right? I read an article with Goldman on something like this.
It was a little better than that. With compounded return, it depends if we were talking price or compounding. So with compounding, it was about 11%. But guess what it's been the last 25 years? With compounding, index only, and this does not include like the fact that you're going to have a cost. Indexes are free, but nobody can invest in them.
What is the annualized return?
About 7%.
Which,
now, if you look,
sneeze out.
Which is not bad, but it's half, a little less than half of what it used to be. So we're seeing over the last 25 years, how many people are out there saying you can still get 10%, you can still get 12%. We're seeing return compression. And if you are not in 100% in the S&P, which most people aren't, most people might have an 80% allocation, 60% allocation, then you're getting 5%, 4%. All of a sudden, it's like, this passive investing isn't doing very well. Why? Because 2000, the dot-com bust blew it up. 2008 blew it up. 2018 blew it up. 2022 blew it up. If you can eliminate just those 5 to 6 years, your return annualized jumps up to close to 10%. Losses compound more than gains. But the problem with investing is most people, just like this lady I was talking about, are fighting so hard to say, well, the only way I'm going to do better is to get more return. That's when they go outside their comfort zone. They go outside their philosophy. They think if I have no fees or costs whatsoever, then I'm going to do better because those things are eroding my performance. I would argue that this is an area where active allocation can work. Because if someone is out there truly trying to reduce and prevent those losses, they may not get you the best gains. You may drag the market by multiple percent a year. But if you eliminate those 5 years, you will have beaten the S&P 500 over the last 25 years. It's that simple. So active management can protecting against risk and downside, critical to your performance, much more so than trying to get a better return. But most people are focused on how do I get better return? And they start with passive and free. And this is where help can really matter.
Yeah, that's great, Doug. I totally agree. Megan, what about you in terms of active, passive? I know you're probably more, well, I don't want to say passive, but how does that kind of come into conversation?
No, actually, no. I agree. Doug and I are on the same page. I mean, I think it depends on an asset class by asset class basis. When you think of emerging markets, I mean, I think one of the best stories to think about is you always hear when you're hearing about emerging market funds, this concept of boots on the ground, right? We use it all the time in the investment industry. But what was interesting leading up to the invasion of the Ukraine is that while, a lot of emerging market funds had exposure to Russia, they had started to notice things going on, boots on the ground, right? They noticed that the reserves in the banks were going up. They started to hear more about the military movement. And you started to see active managers in emerging markets divest themselves of Russian holdings. And I bring this up because when the invasion happened, what we found was that our manager had less than 1% in Russia by that time because they had been divesting. So going to it, I don't want to repeat what Doug said because I think he said it really well, but adding on to that, active management is very important in certain asset classes to protect your downside risk, and so it's well worth doing. However, I do feel that for most people, the investment market has been looking to them like it's a very short-term gain, right? It's all about, can I make return this year? And I think if you take what Doug said, you also have to layer on time horizon. So whether you are active or passive or a mix, which is what we do, and it sounds like that's what Doug does as well, you also have to keep in mind, this is not about 2023. This is about over the long term, having the portfolio return and getting it to a point where you can eventually live on it and to keep up with inflation and to grow it to meet your living expenses. It is not the game that you see on CNBC. As much as it's a great TV channel, it's a little too frenetic for investors. So, but the last thing I will say in this is, if you are unsure of what to do, don't be afraid to go into the market. What I like about the pure passive investing robo world, and I wish Barb was here for this, is it at least gets people in the market and gets them investing. And get in there, put your money to work. You're going to need it to keep up with inflation. And really, it's the people who want to get into portfolio management that should be having more of the debate between passive and active.
Yeah, no, that's great advice, Megan.
And,
All right.
It looks like Doug wants to say something.
yeah, just
Of course, he always does.
Of course, I know. I agree with that. I think that's well stated. It kind of goes back to what I was saying about, with if you lag the market a couple of years, then all of a sudden, .com hits or 2008 hits. What happens typically? As I said, stay with a methodology. If your methodology is, I'm going to manage this risk, guess what? You might lag the returns during a lot of these great, these great years. Like, I'm not getting what my friend is getting. That's okay. But what happens is they get frustrated because all they care about is those gains and returns. And then they switch their philosophy. They switch their manager. They switch their approach. And guess what happens when 2008 hits? All of a sudden, they don't have that risk management anymore because they switched to someone that was only trying to show them the greatest gains they could get, blows it all up. If you've got someone that understands allocation as a methodology, I said there's no perfect methodology, there's no perfect process, but if it's a process you agree with, stick with it and stay with that. And I love what you just said about the robo world is, guess what? It's the same thing. It's a philosophy. It's a process. If it gets you in the market to do something, it's better than doing nothing. Is there a better way to do it? Yes. Well, even in 401ks, when I get some, what should I do to start out? Listen. Start out with a target date fund. Start out with an S&P 500 fund. You got nothing to lose. You're putting $500 a month into it. Once you get to $500 or $100,000 or $250 or $500, now you got something to protect. And at that point, you probably have to take a little bit more of a tactical approach to what you're doing. But if you got nothing to start with, just get in there in the first place. Do something.
Yeah, no, I love that, Doug. So one more topic here and we'll wrap it up. We want to get into the topic of real estate. I know you have a lot to talk about on this, Doug, but I think real estate has long been this topic of, hey, it's a great passive investment and it's a great way to get passive income. And, there's a lot of, themes out there about real estate. So I really want to just kind of like dive right in here and ask Megan, given the real estate market has changed a bit, is real estate a good passive investment, or like how should people be looking at real estate right now?
Yeah, I think a couple things here. First of all, I think the calming of the real estate market is actually a benefit for all Americans. The freneticness that was going on over the past 2 years is actually not healthy for anyone. And it also hurts Americans trying to get into the marketplace. But the thing that I've always found interesting in working with wealthy families is how much real estate they hold. It's never lost on me, but they also hold it over the long term. So I think the thing that is really important here is knowing the role that real estate should play in your portfolio over the long term and what you're trying to achieve from it. Now, one of the most interesting data points out there is that because interest rates were low for so long, a lot of people are deciding not to sell right now. They want to hold tight and see what happens. And they're able to rent out their properties. And I think that's an interesting factor because I think you may start to hear more of people who are actually able to take advantage of having passive income come in because they didn't sell the property because the frenzy is over. But the other thing I'll say is I'm in the middle of putting a house up on the market. And it's been an interesting experience because what I've talked to with my realtor and understanding the data is because inventory is still low in certain markets, it still means that some housing areas, the prices are able to maintain themselves, right? It's just, instead of having 7 all cash buyers, you're going to have two buyers, 7 all cash buyers who are buying over the price that's been posted. You're going to have maybe 1 or 2 potential buyers who will be buying at the actual asking price. And so making sure you have reasonable expectations of that is really the key part.
Agreed.
But I'm not worried over the long term.
Okay, great. Doug, your thoughts?
The thing I like about real estate is that it's a tangible asset that even though and unlike a lot of what a lot of people think, a lot of people like real estate never goes down. Yes, it does. But it's like a monopoly board. It's a collection of assets. Unfortunately, the downside of our industry and the investments, the tradable world is people see the statement and they see, oh, it's worth 500,000, and they see it next month and it's only worth 480,000. I lost 20,000. No, you didn't lose anything. Losing money, if it's your bank account, you got robbed. Call the police. But the problem with the monthly statements is it's showing you a valuation of what they would be worth had you sold it. Okay. So some guy on Wall Street says, I want to sell 500,000 at 3M. And some guy on Wall Street that's buying says, yeah, I don't think 3M is going to look very good next month. He goes, well, I want 500. No, I'm not going to give you. I want to pay 460. And all of a sudden they agree on 480. Boom. Now you have, that's assuming you only had 3M. Now your portfolio says 480,000 because that's what 2 groups in Wall Street decided that cost would be. And you see it, you're like, I lost money. No, the guy that sold it for 480 lost money, but you didn't. That's the problem with regular investments. We see that volatility and it has nothing to do with you. It has to do with what people on Wall Street are doing and trading based on outlook. The thing about real estate is it doesn't move like that. You don't get to see that statement. If you have a margin account and you have a loan against a margin account and it falls in value, they can pull your loan. Mortgage company is not pulling your loan if your housing value drops. Okay, you're just going to keep paying your mortgage until it's paid off. So nobody's looking at the value of real estate on a day-to-day basis. It's a long-term hold. I also take a little bit of issue with the idea of passive investing because real estate in itself isn't passive. It's a lot of work. You got to find the deals. You got to do the due diligence. You got to know the markets. You got to do the upkeep. You got to deal with renters. You got to deal with all this. So true passive is I put my money there and I get money. I don't have to do a thing. This is actually a fairly active type of investment. It's just maybe a little bit different than trading every month in your brokerage. But one last thing I think is really funny, and I do think the markets are going to be fine. Its assets are still tangible. There's only a limited number, piece of land. My first rule on real estate investing is, do you want to be a landlord? There's a lot to deal with. But I sent you a tweet I saw the other day. I thought this was pretty funny. In 1958, Warren Buffett bought a house in Omaha for $32,000, which he still owns. It's now worth $650,000. Raise your hand if you think, hey, Warren Buffett made some money. Well, if he instead slept on Charlie Munger's couch and invested those funds into Berkshire Hathaway, it would be worth $1.2 billion. Lesson: don't buy real estate.
I love that
I thought that was really funny. He said one caveat. They said one caveat: they didn't fully take over Berkshire Hathaway until 1965. However, there's a 3,641,613% rate of return on his investment in Berkshire. So he's done pretty darn well there. Listen, I don't have a problem with real estate. I think it's a great asset class, but like anything, it's one of those things. And I think we're going through some challenging times right now with interest rates. We're going through challenging times with people that own these properties that want to sell, that they'd like to sell. But I mean, my wife's cousin right now is looking at moving. He's in an area where there's gunfire in the cities. Not a great place to have a home. He's actually had someone try to break in a month ago, and he had to literally shoo him off his porch with a gun. Okay. But he just said, if I try to move anywhere, it's going to cost me $900,000 to move. He can't think of a place to move right now that's actually going to be a very equitable move in the current marketplace. These things will work themselves out over time. But real estate, just like you were talking about, today, it's all about this quick return in the markets. Unfortunately, we have also fallen into, with all these HGTV shows about flip it or fix it and flip it and whatever. People have started to view real estate as a very short-term investment. We're also, last thing I'm going to say is we're starting to see some data. Super Bowl was last weekend. A lot of people have gotten into these daily rentals with Verbos and Airbnb. They've had such a blow up of them in Phoenix that while they were expecting to be fully occupied, as of last week, they only had 38% occupied for the number of rentals that were out there, and they actually were dropping prices from like $2,500 a night to under $500 a night, and they still couldn't rent them. So I think that's another thing. A lot of people have gotten into this again for that return, that high yield on Airbnb. We're starting to see an oversupply of that, and you're starting to see in markets a lot of market pressure. I've heard that Vrbo is going to reduce the number of people that can list. That's going to force some of these nightly rentals to move into more long-term rental space or sell the properties. So that's just another variable that I think is something that's got to be noted and going to be watched really closely.
All right. Well, I appreciate all this insight from both of you, and we're going to wrap it up here. So, Megan, where can people find more about you?
Sure. You can find me at Forbes.com/Megan Gorman. So, thanks for having me on, Kirk.
Thanks for coming on, Megan. And Doug, where can people find more about you?
Well, I assume there's some business owners listening to us today. So find out more about us through our company, Automatic Business Method. We actually have an 8-step cheat sheet for business growth. No question. There's a lot of variables. Really, it's never easy to run a business, but since 2020, things have gotten even crazier. So, listen, don't fear, don't have doubt on the economy. If your work life is, got too much stress, not enough time, the 9-step method will help you transform your business in as little as 90 days. It's actually a 9-step method with an 8-step cheat sheet. So get out there, learn how to boost your revenue, create business performance culture, get your time back. That's the number one thing that most business owners crave. Go download that cheat sheet for free at automaticbusinessmethod.com.
Great. Well, thanks again for coming on, Doug, and thank you both. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.